Welcome to TMS Insights, our first edition for 2019. Jeremy Hook and Ben Clark bringing you an update of what's been going on in the markets since we last spoke in December. Now, 2018 had a nasty quarter to end the year, but January started really well. Ben, it's up about 4%, so a little bit of relief for us to begin the new year and to start planning for what's coming up.
Yeah, absolutely. Volatility has calmed down over the last few weeks from those incredible swings we were seeing into the end of the last year. And it feels to me like some of those sort of more Armageddon headlines have dropped away, people calling a recession in America. There are still issues, of course. We've got the trade war continues to grind on. We had the government shutdown over January, but that should be a blip in hindsight. And then, in Australia, we had quite a few downgrades coming out into the end of last year. We've had some more at the start of this year. Some economic data that's a bit sort of up and done, particularly the forward-leading forecasts.
And all that sort of hits the rubber hits the road really with the bond market, which is a much bigger market than equities. I think we've explained that, but gives us a real guidance to a number of things. Now, what's important is the change in that yield curve, Ben.
Yep.
And if we can just demonstrate for people how that's good for equities too.
Yeah. So, leading into Christmas, what we saw was a rising bond curve. And so what the bond market was telling us that interest rates over time would slowly increase. And in fact, if you remember back in October, November, which is when the correction really started, the concern was that bond yields were going to go up too rapidly.
Right. And we had the Fed raising, of course, and this sort of stuff. A normal curve is positive, isn't it? That's fair to say. But that changed in December and still the same way now.
It's actually continuing to change. So now we see I'm talking in the Australian bond market here, a 5-year bond yield which is now 0.2% below the current market cash rate, and a 10-year bond yield which is now very close to the current market cash rate.
So it's virtually a flat yield curve.
Flat yield curve.
And the suggestion there is rates aren't going up, they could go down.
Suggestion is lower.
Growth is probably a bit of a risk factor into the year ahead.
Absolutely.
And we saw that coming out today in the NAB Business Conditions Survey, which showed quite a negative read, the biggest 1-month fall since the GFC. So that was the state of mind of business leaders in December.
Yep.
Now, what will or won't have changed will be, I guess, a calming in US markets and global concerns about trade seem to have certainly eased somewhat. In taking it to our reporting season ahead in February, which we'll look at very soon, companies did in Australia in more number than they downgrade earnings outlooks. So we got that sense that it's affecting company level as well.
Yep. And, the weird thing about it was in a whole lot of different industries and different styles of companies, but we certainly saw a good number of downgrades leading into the end of last year. We've seen a few more at the start of this year. Credit Corp, which is normally the first company to start reporting, has kicked off today. We've actually an upgrade, so there's some good news there.
Good news, yeah.
But it's it's going to be an interesting 4 weeks ahead of us as we sit through all of the news that will come out.
That's it. Now, a couple of companies have given already guidance in the last week about the state of their earnings. Challenger we should talk about because that's a stock that we looked at closely over the last couple of years and certainly own widely. So, Ben, a downgrade there. New CEO Richard Howes at the chair at the start of January. Is this a typical clearing of the decks from a new CEO?
I think there's an element of that. So the company at its AGM in October guided for 8 to 12% earnings growth for the calendar year, the financial year, and it's reduced that down to 2 to 4% earnings growth. Now, half of that downgrade has been due to the incredible volatility we saw in December. So at the end of every 6 months, Challenger has to market its investment book. And with the massive spike in volatility and in bond markets and also the drop in equity markets, it marked to market much lower than expected. The second thing, to me, looked like a bit of clearing of the decks.
Yeah.
So a few little one-offs, sort of a few $1 million here, a few $1 million there. And that felt a bit like, whatever bad news we think might come out, we'll put that out there now.
And yet the market will wonder and worry that it won't be the first downgrade, won't it? Because, the last downgrade, because that is the case. So nobody should be surprised by the investment performance going down. That will happen in a soft quarter or a soft year. That's normal. So that part doesn't worry us. from this point we're pretty happy with the longer term settings of this company.
Yep.
And we've met the new CEO in investor conferences we've been to, and we're confident about the capacity of him to run this business well.
Yeah, I think it should be pointed out, when we went to their investor day, probably in September last year, Brian Benari, the old CEO, he was very upbeat about the MyEFO reforms that the government had announced at the time. And, this is a bit of a thing that's going on in Australia at the moment, is continual changes in regulatory events that affect companies. And so,
because this was deferred by a year ultimately after they decided.
That's right. Yeah. So they've been pushed out, and there's been a whole lot of other stuff that's been pushed out, and there's the inkling that some of it might not even happen at all. So that was something that was seen as accelerating the earnings of this business, which will still grow, but might, without that tailwind at their back, might not grow at quite the rate that we were hoping for.
Yeah,
but
we're still pretty upbeat about the company longer term, aren't we? Yeah.
Absolutely. And look, we didn't hear from the CEO. They didn't do an earnings call. They'll be doing one on the 13th, I think it is. So we'll hear from them then.
Okay, ResMed's been a terrific stock over a really long period of time, and typically gives us very good news when it reports. It reports early in the season. Its quarterly numbers came out last week, and they were a little underwhelming, but not by a huge margin, Ben, but the market seems to have taken it pretty badly.
Yeah, look, I think this one's a bit different. This is more a company, a week ago there were 3 stocks in the ASX 200 which hit an all-time high. There were Technology One, Appen and ResMed. And I think this was more a stock where everyone was really piling into. The PE had got probably...
Because this didn't get sold off at all last quarter when everything else got sold off.
It kept actually going up. Yeah. And so, that although the quarter was softer than expectations, it was still a good quarter. Yeah. And it was well forecast. When we listened into the quarter before, the CEO was at pains to say the next quarter is going to be slower than this one. And it's almost like no one listened at the time that was going to happen. Yeah. But to me, when you're reporting quarterly numbers, all companies go through good quarters and slightly softer quarters. The growth trend there is well and truly in place.
And that's, to that point, that's one very good reason why a lot of companies abandon quarterly reporting.
Yeah.
But being a US company, it's got a different regulatory environment.
That's right.
Now, talking about the US, there's been a lot going on. Obviously, it's the biggest market in the world from our point of view in equities. And Ben, we want to let viewers know of a pending trip that we're going to see a lot of companies, including going to the Berkshire Hathaway AGM in late April, yourself and me, which will be a good trip for a lot of learnings about a number of the companies that we invest in and the broader environment.
Yep, absolutely. I think it's also probably a bit of a sense that this might be the last time we see both Warren and Charlie Munger present at the same conference, and given their ages, and but this, from all accounts, and a host of Australian fund managers do this every single year these days, and I think there's a lot of getting a sense of what's going on in the economy over there on the sidelines. A lot of broking firms now host investor conferences around this because there's so many Australians go over for it. So I hope it's going to give us a bit of a feel for what's going on in America and whether there is a bit of a change happening in the economy there. And hearing from one of the world's probably most successful investor is going to be a good thing.
So that's a few months away. What's coming up sooner is obviously reporting season. February is a really busy month, of course, for us. So most of the companies producing half-year numbers. I think we'd probably look at it expecting some mixed results, Ben, that some will be typically quite good and some actually will surprise to the downside. Yep,
I think so. Look, it's... whenever you own 25 to 30 shares, there's always going to be 3, 4, 5 that you sort of got concerns about at the time. It is that sort of economy and market at the moment where not everything is just sort of moving ahead in a linear sort of fashion. As we said, we saw a lot of downgrades going into Christmas, and we sort of felt like we avoided a lot of that bad news at the time. And I think it points to just, it's probably going to be a bit messy.
I think,
But one positive I'd say is that expectations now have come right back.
Right. So there could be some of the messiness could be good on the upside as well. So
you could see results which aren't great, but because everyone was expecting they might be a bit worse. Yeah. And you've seen with Credit Corp today as an example, you could actually get quite strong share price reactions to actually not that much of a change in the language.
That's right. So, we will bring you a couple of insights over the the February reporting season. And just lastly, before we go, Ben, a big release coming out on Friday. The Royal Commission into Banking will be given to the government. We don't know what we're going to learn straight away about that, and we think it might even be after market on Friday, but clearly something to be watching, and it's got banks a little concerned, no doubt about it. Yeah,
definitely. So this is the long-awaited event we've all been waiting for. I think it's a positive that we're getting to this point. Like, you know, this has dragged, I think, over the market's head for over a year now, and it's almost the uncertainty of what's going to be released, I think, will probably turn out to be not as bad as the recommendations that are put in place. But we'll wait and see. As you said, we don't actually know when it's going to be made public. So that's a bit of a question mark. But I think it's probably a feeling of sort of getting it over and done with.
It's time to hear it so we can, and the current government can at least begin to implement some potential changes.
Definitely, yeah.
All right, that's all we've got time for today. Again, reporting season pending. We'll look forward to bringing you some updates from some quality company reports over that period.